Disney streaming now turns a profit, and they just reported earnings. We're going to dive into those earnings along with another one we've done tremendous amounts of videos on and we've actually been pretty bullish on, and that's going to be CVS. So on the last earnings, we saw CVS's healthcare really cause the big problem with their fundamentals. And once again, they're chopping 2024 forecasts because of these health insurance costs. So we're going to dive into these two stocks because we've done fundamental analysis on both of these companies. Now for CVS, I said anything under $56 I thought was a gift, but we have to go back to the drawing board once again on this one. It's definitely been frustrating. I've been kind of wrong on this one. I think if you bought at the prices I've recommended, you've been fine. It's death by 1,000 paper cuts, and it's very, very frustrating to own. The only nice thing is you're getting right around a 4.5% dividend, and you're also getting a stock that's still trading at a decent valuation. I do think we're going to probably see downgrades and a washout on the stock, so you could be getting it in the low 50s, high 40s here, and I just want to bring that to your attention. As you guys can see here, I have a DCF model of 51.15 with a 10% margin of $46, so we could definitely get into these levels with downgrades. So let's get into these two stocks. About a list of 10 stocks I have to break down, so there might be a video coming where I just break down these 10 stocks. It might be like an hour-long video, so be aware of that, and I'll timestamp it so you guys can click through the stocks you're interested in. But as we see here, we got a little bit of a sell-off on Disney. We have an ideal price target of $74. That's actually going to be bumped up now that they've incorporated a dividend. In 9 months ending, they're still growing revenue in both services and products. They recently raised the cost of streaming, so that's going to come through on the numbers. And streaming just turned to profitability. So to me, I like Disney a lot when we think about consumer discretion. They are well diversified. They have hotels, they have parks, they have cruises, they have streaming. So when you're buying this one company, you're essentially really getting integrated into the consumer in many different areas. So if one area fails, you hope that the other area can pick up. So I do like their business model from that perspective. Of course, I do think there's a slowdown coming, and this could be one that actually gets hit. The CFO did speak today, and he did state that consumer is softening here, but still strong numbers going forward. The net income has over doubled from last year, and quarter over quarter just smashed net income. So we're starting to see stronger fundamentals come through the stock. Last year, they earned negative 25 cents. This year, they earned a positive $1.43. And so we're starting to see the fundamentals really pick up in Disney here. Cash and cash equivalents are down here, which don't love to see. A lot of capital expenditures with this company. The thing about Disney is they are building a great content library here. They have the Deadpool Wolverine movie, making historic ratings on an R-rated movie, doing $444 million globally. The amount of successful movies that actually have been coming out for Disney have been quietly doing extremely well. So they're building a great portfolio within their streaming business. Parks are starting to slow down. That's going to scare some people, I think. But streaming is profitable. The parks are still profitable. There's a lot of good things to like here. I think historically, with earnings now going positive, this might be one of the cheaper valuations we've seen on Disney. So because they didn't give us any forward guidance, I'm going to use $23.2 billion of revenue to break down what I think they're capable of doing. Now, we have to keep in mind that they are going to raise prices on streaming, so that is going to positively impact revenue going forward. I think they're going to be able to do closer to 24 times 4 quarters, or $96 billion for 2025, I think is a realistic expectations. You guys can see what I'm projecting revenue to be, coming right around 97.4, 103, 109, 114. They're consistently adding more parks, they're consistently adding more cruises, and so I do think revenue will steadily grow. A big part of this is, it's going to be up and down, so I'm going to keep this $80 price target to build some safety in here, because I do believe that the consumer is slowing down, and we could see a pretty substantial pullback on Disney. Now, with these earnings, they're extremely positive. I think to get streaming in the positive is extremely important. They're like the second company to do this next to Netflix. It's been a hard task for a lot of companies to even do this. And we could see a mild move in the stock because of the fact that the parks showed a little weakness here, which is now going to lead us to CVS. Before we completely trash CVS here, let's look at some positives. They're still growing revenue, and we're talking about $370 billion of top line revenue that they're still guiding for in 2024, with adjusted EPS coming in around $6.50. Just to build some safety here, guys, because we've gotten trashed by CVS a few times, I'm going to knock this down to $6. So currently the stock's trading at $58. We divide that by $6. We get a 9.6 forward PE for CVS on an adjusted basis. So you're paying 9 times earnings, which is extremely cheap, but rightfully so because the company keeps guiding down. But they're still getting that top line revenue growth. Once again, it's the same story with CVS. Are they going to be able to widen these margins? This is a very low margin business, and it is very scary on the cost that they're incurring when it comes to the healthcare side of their business. The thing I absolutely love about this business is they do have the storefronts. When the consumer strengthens, it's there. But look at these premiums that they're collecting. $61 billion in premiums, and look at the growth quarter over quarter, going from $25 billion to $30 billion. And so yes, they're losing the storefronts, but they're catching it on the premiums. And at some point in time, I believe the storefronts will equal out. I believe a lot of the storefronts are going to remain open in busy areas and nice cities. And we're probably going to see a lot of CVS storefronts kind of close down in those rural areas that are not getting the foot traffic. But here's the big problem with CVS is these healthcare costs keep going up. This is becoming a huge problem. This is a big reason why I sold some calls against my position, had it called away, broke even. But now I'm looking at it and I'm like, these healthcare costs are still going up. And this is definitely becoming a massive headache for CVS. Now, in the presentation, they talked about $2 billion of healthcare savings. If this is true and they're still able to grow revenue, then they should start surpassing 2023 net income. And that'll be a huge catalyst to push the stock back up to the $70, $80 range. Cash and cash equivalents are sitting at $12.5 billion. Long-term debt is sitting at $62 billion. From a free cash flow standpoint, I definitely think the $55 range makes sense. From a multiple EBITDA, we could pay as much as $60 a share. We get a $57.50 ideal stock price. But as I stated, I lean a little bit more on the free cash flow side. So I'm going to give an ideal price target of $55. Currently, the stock's sitting at $58.25. We could see a significant sell-off with some downgrades here, people just throwing in the towel, which would then lend the opportunity to possibly buy, as I stated, maybe even the high 40s, low 50 area. And I really believe the risk versus reward at this point in time is still there. I know I've said anything under 56 is a gift. It's still kind of in that wheelhouse. Anything under 55 now to me is pretty much an opportunity. Earnings report, I think people are kind of just fed up at this point. But at some point in time, the bottom's going to be found in this stock, and I think we're closer to the bottom in this thing. I could be wrong, of course. I've been bullish on the stock, basically, but I've always had an ideal price target around $56 to $57. So I haven't been really wrong as we look at the stock price sitting at $58 today. As always, guys, appreciate your time. Thanks so much for spending it with me. We will see you in the next one.